Welcome to the Retirement Answer podcast. I'm Dan Goldie, your host. I'm the author of the upcoming book, The Retirement Answer, and this is the podcast where we simplify complex financial decisions. I'm here with Monie and his ADU. This is our normal podcast studio, and this week, Monie, we're talking about behavioral finance. These are the heuristics and issues that we all have because we're not all rational, especially when it comes to money. And so I pulled these 8 heuristics out, asked AI to summarize this for me, and I went through it, and I sent you a summary of it, and let's talk about it.
Yeah, I think none of us are wired for finance, at least the way that, based on your notes, I've been reading. And I think every one of these heuristics, and let me maybe I'll simplify for the audience a little bit.
Well, you can define what it is.
Let me define what it is.
Yeah.
So basically we're talking about the intersection of finance and psychology. Why our behavior patterns don't really line up with a rational actor in the world of finance, or what you should be doing as a rational actor when dealing with finance. And it's sort of broken into, I think you broke it into 6 or 8. 8.
There's 8 of these.
8 of these, yeah. And we're going to go over why your brain isn't wired for it to begin with. And then we're going to talk about something called loss aversion. We're going to talk about recency bias. We're going to talk about confirmation bias. We're going to talk about anchoring bias, the endowment effect, present bias, and mental accounting. So we're going to go through each of those so we can, I think everyone has experience with all of them. Once we describe them, everyone's going to be like, oh, yeah.
You wouldn't know the name of what each is.
Exactly. It's like,
but
I just did this.
But you would say, I did that, or my friend did it,
Exactly.
or I did this a long time ago.
Exactly. I think what helps here is we help to put a context around everything. We help to put a vocabulary to what you're actually experiencing in real life. And then maybe that'll help everybody who's listening to this or who's going to listen to this recognize these patterns and keep themselves
recognize it early.
Or recognize it early.
Earlier than you otherwise would, if you would at all.
Makes sense. Makes
now
total
you
sense.
recognize it early. Hopefully, the more that you hear this.
Right. The idea is to educate yourself and to keep yourself from falling into these traps when the time comes.
But unfortunately, we all have these biases.
Yeah,
we're all human beings. Our brains are all wired the same. So it's just a matter of getting...
Well, I can tell you I've literally done every single one. As I was going down the list, it didn't click when I was reading just the titles of them. Like when I was loss aversion, what does that really mean? The endowment effect, I didn't understand what that was until I read it. And then I was, oh, yeah, I just did that like last week, Or I can show you any handful of texts I'm exchanging with friends or family members about investments where we're doing this, right?
Well, these are academic names, that they apply to whatever the issue is. But when you start to see examples, I'd really like to focus on examples because I have numerous examples from my past, my advisory past, where I've had clients do all of these things.
Yeah, the best kind of examples, real life ones, right? Or I'll talk about some of the stuff I've done. And some of the stuff I continue to do, but now I won't. Hopefully, I'm better educated now about it. Sorry, just getting over a cold, guys. All right, let's start with the first one. Why isn't the human brain wired for rational investment choices?
Well, I think it all comes down to our evolutionary history. We evolved as a species over tens of thousands of years. Our species is basically 350,000 years old, our current speciation. And the things that allowed us to survive out in the savannah, out in the wild, are exactly what trip us up when it comes to money. Give you an example. This, this loss aversion, the first topic that we're going to talk about. If you were out in the wild and you're in a savanna with tall grass and you're out there by yourself, or even if you're with a group and let's say there's, lions around back in the day. I don't know what tens of thousands of years ago, what kind of animals would be out there that would be risky or threatening. But let's say you see the grass moving nearby you, and are you going to stop and do an evaluation and talk to each other about, well, gee, maybe the risk isn't that bad. Let's wait and see what that is. No, you're going to run.
Because the downside of making a mistake there would be death, right?
Yeah, that's where the loss aversion comes in. And we'll give some real world examples today about what that means. But we wouldn't have survived if we didn't have these things like loss aversion, where you can't take a risk of having some animal chase you down because you're dead in that case. You can't make even one mistake. So what's your natural response going to be, and what is that wired into our evolution is into our DNA, our evolutionary history is this running to safety. If we see a risk, we perceive it in any way, or if it's even slightly possible that we're going to have a problem and lose our lives, we're going to run.
So basically the same primordial brain that kept you safe, many thousands of years ago is what makes you sell at the bottom of the market.
And all of these other things that we're going to talk about. It's just wired into our brains. So you really can't avoid it. And as we were talking about in the beginning of the episode, like you can at least educate yourself that these things exist, and maybe you can recognize them quicker than you otherwise would. But you can't avoid them. You can't turn them off. It's just part of who we are as humans.
So then the next question would be, how do you protect against that kind of behavior? Or how do we prevent this kind of behavior if we're naturally wired for it?
I don't think you can prevent it, but I think, like I said, you can recognize it quicker so that perhaps it won't happen to you. And also I think you need to, anytime you're making any kind of financial decision, it really makes sense to stop and be patient and think about it. Like, don't just respond based on your emotion. Like, if the market's falling, don't just sell. Think about it for days, weeks, and check in with the Retirement Answer book or some other book about investing. Or if you have an advisor, check in with your advisor. Okay, well, this is how I feel. And a good advisor will tell you, yeah, that's normal. It's not unusual, but don't do anything about it. Don't respond emotionally and make a mistake. So you got to recognize it early, be patient, like work in with some behaviors that take time. Like don't just jump into it. And then I think having a written plan is really helpful. So that if you're feeling, so let's say, for example, you're panicking over a market condition of some sort, if you consult with your investment policy statement that you hopefully created for yourself or your advisor created it for you, we do that with all of our clients. Every client has an investment policy statement, and we follow that statement. And whenever clients feel stressed out or emotional or scared about something, we refer back to the policy statement and we say, look, we expected this to happen. Here's the statistics about it. This is not unusual. What you're feeling is not uncommon at all. So let's think about whether you want to make this change or this move in a way that's consistent with your policy or not.
So you have a framework to work with rather than a fear-based reactionary approach. So when you feel that fear, you go back to your framework and find out whether any of the decisions you're making with regards to selling something, or in some cases procuring something, fits with the framework, or are you doing this strictly from some gut feel, like fear,
emotion,
or emotion?
So there's three things, I guess, that I would say is, have that written plan, go back to the plan. If you're going to do anything, make sure you take plenty of time so you're not reacting emotionally. Let the emotion pass, let the stress pass, and then make the decision under a calm mind.
Makes sense.
And then also just being able to recognize these things that you may not have recognized before, or at least recognize them earlier. Those would be the three measures I would take. I don't think you can completely avoid these things because, like I said, this is part of who we are as humans.
Okay, well, then that's a good lead in to our first heuristic, which let me define heuristic real quick. It's a mental shortcut.
Mm-hmm.
Okay, so we're going to talk about within the context of our brain not being well suited to making rational decisions for investment. There are these sort of 7 or 8 heuristics that we're going to talk about today. And the first one, I think everyone is going to relate to all of them. The first one is called loss aversion, and that basically means fear of or pain and loss. So lay it out for us, Dan. What does it really mean? What does loss aversion mean? And then give us some good examples of loss aversion.
Well, economists and psychologists have studied this loss aversion pattern, and what they found is that the pain of losses is 2 to 2.5 times more painful than the joy of winners. So losing money hurts a lot more than winning money helps.
Wow. So if I were to, let's just put it simple example. If I were to make $100 in an investment, it doesn't feel that feeling of joy, I would say,
excitement,
or excitement of making $100 is outweighed, if you will, by the feeling of losing $100 2 to 1. In other words, losing $100 feels way worse than making $100.
Yeah, they've done studies where they've given people a choice between trying to remember exactly the numbers, but it was something like I can't remember now, but there were some examples where they found that's how they came up with this 2 or 2.5 times more painful for losses than the joy from winners. So people really hate losing, and this comes back to our evolutionary history where losses meant the end of your life, and that gets transferred now into the modern day. And we're really stressed out when things don't go our way financially. So if the markets are down, we're panicked.
Okay, so just to recap, losing money feels twice as bad as making money feels good.
Mm-hmm.
And I don't think there's anyone in the history of investing who can say they've never lost money. We've all lost money, and we're all scared of it. I'm deathly afraid of it. Every time I walk into an investment, I'm deathly afraid of it. Every time I sell an investment, I'm deathly afraid of it. And I think it goes back to the impact it has on you psychologically, right? Because the entire time you're just like, if you do lose money, there's been multiple times where I've sold early and I've made money, but just the difference in what I would have made if I had held on to it maybe 6 months more or 5 months more makes me, go crazy.
That also might not have worked out well for you. Like
exactly.
For example, I've had clients come in with appreciated securities that they don't want to sell. It just doesn't feel right. And then they have others that have come in with losing securities that I want them to sell and diversify. But they don't want to sell them because then that, quote unquote, locks in the loss. Like, mentally, just in your mind, if you haven't sold it, you haven't actually realized the loss. And so that also plays with you in a way that is not beneficial.
So basically the fear of loss works both ways.
Yeah.
It works if you don't gain as much as you thought you were going to gain, even though you gained something. And it also works if you're losing money and you want to sell something and you're thinking that it's going to rebound or come back to...
You're hoping.
Or you're hoping.
Hoping that it will.
You're hoping.
Yeah.
Yeah, that's right. Hopium.
And when you actually sell, if your advisor tells you to sell and you actually follow that advice, then, oh my gosh, at least for a short period, you've locked in your loss. It actually has become real now.
Do you have any good concrete examples from this over the years that you can give people?
Well, yes. I mean, I don't want to name names or go through the specific securities, but
Sure.
Being here in Silicon Valley, you have a lot of people with winners, and you have actually quite a few losers where markets just the stock just hasn't done well, and people like to hold on to it. I think that's the same probably for everybody everywhere. But in Silicon Valley, it seems like there's a lot of ups and downs. There's companies, stocks that have done really well and stocks that have done very poorly. And then another thing that's related to loss aversion is just what you were talking about earlier, which is fear of market drops or price drops if you have an individual stock. But if you're investing and you have a diversified portfolio and markets are down, it's especially painful, especially scary. I've had clients, there was one I can think of who left me, is not working with me anymore because he wanted to do something pretty much every time markets were down. He wanted to make a move, and he was afraid of the decline and what it would do to his finances. And I kept ongoingly advising him, look, let's not do anything that's not consistent with your investment approach. And then sometimes later, we did reduce his risk because we realized he was taking too much risk for his own personality. But still, he ended up leaving because he was just so afraid of markets that he had to sell out and move on. And that's what he did. So that fear, it's more than fear, it's the pain. It's the pain that he's experiencing from the down market, the temporarily down market that caused him to no longer be invested properly.
Right. So it's not just the loss of the money or the perception of loss of the money. I would say if you do sell at a point where you're either break even or just a little bit higher, but then you didn't make as much as you wanted to make, it's the pain after the fact. That's a big one because I have to say there have been multiple times in my life where that's happened to me and it sucks and it causes you a lot of grief over a long period of time. So what is the antidote to this? So
the antidotes are all the same, I think, for all of these heuristics. The three that we mentioned in the beginning.
Okay, so that was a good extreme example of someone without the mental acuity to deal with the pain of loss. Do you have something in between, like an example where the person is not so risk averse or so fearful that they're going to leave all their investments, but that ends up possibly trying to make bad choices along the way as markets dip, for example?
Well, let's just shift it a little bit because loss aversion, the way it's described as I understand it, actually applies to almost everybody. And that has to do with the rebalancing that people really should be doing with their portfolios. Rebalancing is where you have some kind of an asset allocation model where you have a spread between stocks and bonds and different types of stocks and so forth. So you have targets for each of these asset classes in your portfolio. And everyone should have that. And with my clients, of course, we have an investment policy statement for everybody. So we have these models set up for everyone. And, it's set up according to their risk tolerance. And what's going to happen, of course, and this happens to everybody, is markets are going to be moving. So from the time you set up your plan until whatever it is, 6 months later, a year later, markets will have moved. And once they move enough where you really should be doing some kind of a rebalancing and getting yourself back to those targets, when that time comes, people have a lot of trouble with it because, in effect, it's this loss aversion works into this, where when the stock market's up, and let's say you have a 60-40 portfolio, 60% stocks, 40% bonds, like just a balanced, normal portfolio. If markets have done really well for a year, you might be up at 65% stocks or maybe even 70% stocks if things have done really well over a year or two. So then what you have to do to do proper rebalancing, you have to sell some of those winners and buy some of the quote unquote losers, the underperformers, to rebalance your portfolio and get yourself back to that stock bond mix. Well, people don't want to do that. They don't want to buy the losers or the ones that have underperformed, whether it's a stock underperforming, an asset class underperforming, or bonds underperforming. There's a whole bunch of these heuristics that work into this, but that's one of the loss aversion examples that I came up with, which is it's painful and scary to buy into something that's down because for one thing. You perceive it's going to continue going down when it's most likely not.
Well, and that is a perfect example of what happens to me every single time I think about rebalancing my portfolio. I look at it and I go, okay, well, I've got a winner here. It's been winning consistently.
Yeah, you want to keep it, right?
And I want to keep it. But then there's this other thing that was doing pretty well before and now it's down. And my analysis tells me I should be buying it. And this is the time to buy it because it's below its mean or its average. But I don't pull the trigger for fear of losing on this one. And then worse, not making as much money as I thought I was going to make on the other one. So that kind of fear of losing out on both. So that's a perfect example. I think everyone can relate to that. I don't think there's a single investor in the world who hasn't been confronted with that choice.
Yeah, and I think that also relates to a bunch of these other heuristics that we're going to talk about, but loss aversion is part of it.
Well, I mean, and it also, that kind of relates, what we were just talking about kind of relates to the second one too, which is, that we're going to talk about, which is recency bias. Do you want to give us a kind of a rundown of what recency bias is and how that works into all this?
Well, again, so if you go back to your evolutionary past, if something is coming your way that's dangerous, your brain is going to perceive that thing is going to continue coming your way. It's not going to turn and stop or do something else. I don't know what a good example would be. If there's a deadly animal charging you, your brain is going to figure, okay, this is going to keep happening. I better move. I better run. I better get out of harm's way. That's what allowed us to survive. Recency bias plays into that because recency bias is where our brain thinks that whatever's done well in the recent past is going to continue to do well. So we perceive these trends that may not be there, probably aren't there. In fact, usually what studies show is when something's done really well for a while, it tends to underperform in the future because valuations get out of whack to some degree. But anyway, so that recency bias is where you continue to think that things will keep trending as they have in the recent past.
So bull market continues to be a bull market forever in your head when we all know rationally that is never the case, right? And that it can turn on a dime and you don't know. So basically what we're talking about with recency bias is past is not indicative of the future. But we're wired to think that way. And so
that's right.
You buy into something, let's say you even buy into a fund that has continually been doing well for the last 2 to 3 years. You have this sense that will continue in perpetuity. And so you don't act.
Well, and we talked about this in one of our very recent episodes where the studies show that past performance is not indicative at all of the future return. So folks would, just be really surprised to see the data. If you haven't seen that episode, go back and watch it because this is something that I was first exposed to 35 years ago when I first came into the industry, where you look at performance history charts and things. If you rank, let's say, mutual funds by performance and putting the better ones at the top and the worst ones at the bottom, and you split them into quartiles, the next 5-year period, if you're looking at rolling 5-year periods, the next 5-year period after that one that you're just looking at, the ones that are in the top quartile of performers are just as likely to be in the bottom quartile over the subsequent 5 years as they are to repeat and be in the top quartile. It looks random. And this is something where the recency bias comes into play. You think that whatever has happened in the past is going to keep happening. And this is why people love to buy ETFs or mutual funds that have really good track records, especially recent track records. Your brain thinks that fund is really good. It's going to keep performing well. And that's just not consistent with statistics.
So give me a good example of recency bias.
Here's a good one. And I think you can relate to this. I think you actually told me this story before. So let's say you're at a party or you're talking to your family member.
I know which one you're talking about.
And they're telling you how amazing they've done, how great they've done. Their portfolio is outperforming everything. And you're going, well, I want some of that. So you buy the same fund that they have held or say that they've held. Of course, what they're not telling you is about the losers they've had. But in any case, you're going to go out, most likely, your brain's going to want to go out and buy the fund or whatever the asset is that they've recently bought or have held recently that is done great. Why? Because your brain says that's the right thing to do.
Right.
It's done well recently.
So Bitcoin's been going crazy. Family friend of mine comes and says, hey, I bought into Bitcoin and boy, has it been, it's been going crazy. It's been doubling every 3 weeks or whatever it does. I mean, it kind of, actually, that's actually relatively close to what it does when it's at its peak. And I go, well, it's been doing that for, he keeps talking about it. He's been talking about it for 3 months now. I got to get a piece of the action.
Mm-hmm.
And the recency bias that's telling me this is going to go up in perpetuity.
It's going to keep going.
It's going to keep going. Gets me to buy it. Inevitably, I buy it, and then 2 weeks later. So we always talk about these biases in terms of like losing money. We usually think about them in terms of losing money, having an investment, but it can also apply to you not getting into the market when you should. Like, for example, and correct me if I'm wrong, but a perfect example of recency bias might be you've had this horrible bear market for 2 years. Markets haven't been great. People have just kind of been, the economy has been slow. People have not been feeling good about investing. And so you've pulled all your money out of the markets and you've been sitting on cash for a long time. And you do not buy into the market. That fear of this continuing causes you not to act. And then inevitably things turn. And
yeah, I think that's a good example. However, I would say as part of my example, like for my clients, I never have them sell out of the market. So what's going to happen is they're going to maintain their allocation as things decline. So what happens, let's say 2008, for example, where markets are down 50%, stock market's down 50%, portfolios are down maybe 30% because you're diversified and you have bonds in there. What's going to happen if you're handling it correctly, in my view, is you're actually going to be buying stocks as and when the market is down in those really low periods. You have to buy them to rebalance properly because they're the underperformers during that period. So to rebalance your portfolio, you've got to sell some bonds and buy some stocks and keep potentially doing that multiple times. I remember in 2008, I actually did that for my clients. I think we bought 3 times as the market was falling and right around the bottom, which I believe was in early 2009. We had 3 separate purchase rounds where people sold some of their bonds and bought stocks, and they ended up all doing really well in the end because the market bottomed, in late 2008, early 2009, and then it just took off after that. So by buying in at those lower prices, rebalancing your portfolio, it worked out well, but no one wanted to do it. I remember it was very hard to convince people that this is the right thing to do. Part of it is recency bias. Part of it is loss aversion. I mean, they all kind of blend together.
Right.
But if you have a down market like you described, following my approach, you wouldn't be in cash and then have to reinvest again in the market. You would still be invested in the market. You'd just be underweight, and you need to correct that underweighting by rebalancing. So it's similar, but it's just a slightly different approach.
So basically, again, it comes back to having a structured framework for doing this stuff, which a lot of investors without professional assistance just don't have. They don't have the discipline for it, and they don't have the knowledge for it. I mean, I'll just say that straight out. But,
well, it's a good argument for having an advisor.
Yeah.
As an advisor can help keep you on track and manage your emotions and help you understand how you might, when you might be thinking more emotionally than logically, and reminding you about, for example, what I did in '08, early '09, where I had my clients, rebalancing and buying stocks down in that bad market, and then the market recovered and they all did well because of it. It's a pretty good argument for having an advisor.
Okay, so let's recap. We've covered 2 of the 8 heuristics that we're gonna talk about: loss aversion, fear of losing, and recency bias. So thinking that whatever happened recently is going to continue to happen, and therefore I'm going to act based on those. Let's talk about number 3, confirmation bias. I think everyone can relate to this one when it comes to social media, for sure, because we all love the echo chambers we live in social media. You say, hey, thumbs up, and to a comment, and then suddenly you're presented with 8,400 other opinions that are similar to that, try to suck you into an echo chamber of people that think like you do.
Yeah, well, you've defined confirmation bias just in what you said. It's and social media is really the perfect example of what an organization takes advantage of that way that we think. We love to hear opinions that are consistent with our own. Oh. We don't want to hear conflicting opinions. We don't want to have a debate. We want to hear more folks that agree with what we think. That's confirmation bias, and that plays into investing in a bunch of different ways.
What's a good example? This one I'm having I guess.
Here's an example. Well, you mentioned cryptocurrency.
Yeah.
You mentioned, Bitcoin. Let's say that you've become a fervent believer in it. And then it becomes almost like a religious thing that you've got to maintain that, and maybe you have to convince other people to buy it. You just become a true believer. And
so instead of going after arguments against it or why it's not going to work, you're going to go look at every podcast and every social media post to reconfirm your bias.
That's right. If you've decided this asset is superior and it's something that everyone should own or what have you,
you try to convince yourself constantly that this is what you should have.
And what are the chances you're actually going to look at something that has a counter point of view? Not very likely.
Not very likely. Yeah. I mean, I find I do that all the time. When I buy into a sector, or if I buy into a particular stock, or I've done this multiple times, actually, now that I think about it, with tech stocks especially, because nowadays you get a lot of people in that echo chamber. I'll name one. Tesla's a big one, right? A lot of people. There's a huge echo chamber for Tesla. You go buy, you can have echo chambers on both sides on the Tesla debate, just like you can on the Bitcoin debate. You can be religiously anti or for, and and
with artificial intelligence,
AI,
there's another one. Everyone's got an opinion one way or the other. And NVIDIA, for example, people love it. Other people think, oh my God,
it's a bubble,
it's
and
a bubble.
And it's not going to last, and so forth. Yeah.
So it's hard to be objective. It's hard to be fact based because of this part of our brain.
Yeah, well, it's and then it doesn't help when the people that are on either side of the echo chamber are supposed to be professionals and providing you with non-biased, at least, information, but it's hard to find.
There's another thing that you just brought up there is, and this frustrates me to no end, which is if you think about folks getting their financial advice from the television, like CNBC or an organization like that, that's not what they're there for. They're not there to advise you or to give you unbiased opinions or give you some information that you can use to make a proper evaluation. They're there to sell advertising. They're there to attract eyeballs. And that's how they make money. And so, they are, and this is not to fault them, this is what they should be doing. They're a for-profit company. They're going to try and create some kind of emotional response in folks. Right. And it just creates more of these biases. It amplifies them so that it makes it really hard for you to make a proper decision.
Yeah, I mean, I would say balanced is boring, right? You're gonna if they come up on TV every day and say you need a balanced portfolio and this is how you balance your portfolio and then buy, you'd probably stop watching them, and you just probably mimic what they do. Instead, what they do is they'll bring on two commentators with completely opposite viewpoints on something, bashing each other, and you're going to pick one side or the other, and it's going to keep you engaged.
Yes, and another thing that this particular bias does, this confirmation bias, is it affects your perception of risk, because the more you hear from like-minded people for whatever the reason, let's say you go back to our Bitcoin example. Let's say you love Bitcoin and you hear all these other similar views on how great Bitcoin is and how well it's going to do. You might perceive it as being less risky than it actually is, because you're hearing all these opinions. In fact, you had mentioned this, but I know that statistically, the price movement in Bitcoin is 6 to 8 times greater than the stock market. It's up and it's down 6 to 8 times more. When it's down, it's 6 to 8 times more down. When it's up to 6 to 8 times more up. So this kind of volatility, you lose track of that because you got all these other opinions that are similar to your own. You might just be putting too much money in there because you're ignoring the risk.
Yeah, so it goes back to reduction in your perception of loss aversion, I guess, right? This confirmation bias makes you feel better about.
Well, it's also like overconfidence, which
overconfidence,
is another one that we're going to talk about. Yeah. These all kind of intermesh with each other. But the overconfidence one is similar, where you think you're better than you are, kind of thing. This is where this confirmation bias makes you think things are not as risky as they are, and you might so you potentially would overweight these riskier items because they seem like sure bets or more likely to do well.
So let's go with a good example of confirmation bias that's outside of. Let's say that is driven by something other. So we've been talking about confirmation bias with respect to a particular stock or a particular class of investment. Let's talk about confirmation bias outside of that might affect your investment making decisions. Politics right now is quite contentious, right? There was a perception that the current administration, the Trump administration, is very pro-business. And so if you look at it through a partisan lens and say, I'm going to go overweight now because we've got a business-friendly, when all administrations are really business-friendly, when we've got a business-friendly administration.
Yes, well, I mean, the politics is a good example of this. And with my clients, I've had lots of opinions both ways. A lot of people who think that, the Trump administration is, like you said, pro-business and we're going to do really well. Markets are going to do well. They're going to contain inflation. They're not going to get into wars, which obviously they've done.
Right.
And then I've had the other side at the same time. I've had the other side who don't like Republicans. They don't like Trump. They think he's scary. And so they think because of that markets are going to do terribly and inflation is going to get out of control and so forth. And so it affects their decision making. And what I always say to both sides, all sides, is, look, don't let politics influence your investment decisions. They don't mix well. Let your political decisions and your political feelings be on the side and separate from the investment decisions that you might be making.
Okay, let's talk about the next one, anchoring bias. And I can tell you, I have fallen into this trap a multitude of, like every other thing we've talked about so far. I've fallen into this one multiple times, and it's hurt really, really bad. And I can give you the first example was, because we came up, my generation came up when the tech industry was first flourishing, late 90s, early 2000s. We had these huge valuations for things like Yahoo and Cisco. And Cisco was a big one. I invested in Cisco And if you guys look at the price of Cisco back in, I don't know, 1998 or
The late
1999,
90s, all of them were way up.
compared to what it is now, I mean, it was insanely high. And I held on to that thing for the better part of a decade and a half thinking it's going to rebound. It's going to rebound. It's going to be back where it was. And it unfortunately never got back to where it was in the late 90s. I mean, here we are, 26, 27 years later.
Well, another example that's similar to that, but that has to do with an entire market, is the Japanese stock market in the late 80s.
Yeah, I remember when I was a kid, that was a big deal.
In the
Everybody
late
was talking about
80s,
it.
Japan briefly was the largest stock market by market capitalization in the world. It was bigger than the United States, just slightly. And then, they had a huge recession, and their market hasn't recovered until, I think, just a couple of years ago, where the Nikkei actually went above where it was in 1990. So there's an example of, if folks kept holding on to a security that tracked the Japanese market, you lost money for 30 years, or you didn't recover for 30 years, I guess I should say. So there's another anchoring issue. And then another one actually that I just thought of this is an example I'd given in a previous episode, where I had a client, an elderly woman who lived by herself. Her husband had passed away, and she was living off of his pension. And so she didn't really need a lot of money, but she had decided that she wanted to wait to retire until her investment portfolio hit $1 million. That was her magic number.
So she was anchored to that
$1 million. And it didn't come from me. It was something that she just decided she wanted to wait for. There's a lot of talk about millionaires, so maybe that was in her head. Like, I want to be a millionaire.
Come from? So
but it came from somewhere.
Yeah.
And I wasn't able to talk her out of it. I told her, look, you can afford to retire now. You don't need to wait any longer. And she didn't need to do that. And so she lost out on several years of her retirement enjoyment, waiting for that $1 million number to hit. And she told me many years afterward, that she waited too long, that actually was a mistake, that she should have retired earlier. But that's an anchoring issue where you get stuck on a particular number, whatever that thing is, and it's hard to break free from it.
All right, let's talk about the endowment effect. This one's good because I couldn't figure out exactly from the title what it was referring to. Do you want to give everyone a quick definition of that?
I'm sure because of your real estate days that you've run into this a lot. The endowment effect. Okay, fancy name for basically just putting too much value on things you own.
Right.
So remember, what makes a market, your house is only worth what someone's willing to pay for it.
Exactly.
So, but a lot of people think their house is worth more than that because they have all their memories there. Perhaps they've done a lot of improvements to the home. They love their house. It's very easy to think that your house is worth more than it actually is, more than someone else would be willing to pay for it. That's the endowment effect. Do you have an example of something that happened back in your real estate days where you were active in real estate?
I have a perfect example. In fact, I have a recent example of that, which is, so I have a friend, we'll just call him a friend, who's built something recently out in the Oakland Hills. And, as a builder, he wants to sell the residential, it's a residential property, he wants to sell it. He's an investor, invested a couple $1 million in building this home and then put it on the market for I don't know, $4.5 million, $5 million a few months back, and it wasn't selling. And he goes, but it's worth XYZ. And I keep saying it's worth, and I said, look, it's worth what the market is going to allow you to sell it for, right? Or conversely, I had a client the other week call me up and say, oh, I found this great property out here. We have several zip codes that are popular. It's a very popular zip code right on the border with Los Gatos and San Jose. This is 95124. Is a very popular zip code out here. Found a property. It was listed around $2.8 million, $2.9 million. And hey, can you do an assessment of what this is worth? I said, okay, well, it'll be somewhat subjective, but I can do an assessment of what it's worth based on recent sales. So you look at recent sales, it was worth about $3.2 million, I guess, give or take a 5 or 7% margin of error. And so they put a bid on the property for $3.2 million. It went for 3.8. Right? Again, that's what the market was willing to pay for it.
Mm-hmm.
Plain and simple. And they thought, no, they didn't own the property, but placing themselves as owners or future owners of the property, they made an assessment of, this is what the property has to be worth. And, they want $2.8 million. I'm willing to give them $400,000. Well, somebody else was willing to give them $1 million over what the property was listed for. So it's subjective to a certain extent. And the market is going to be way more efficient at pricing something in a real estate market, as you said, same thing works in equities markets, than an individual like me going and trying to assess the value of something based on previous sales, which again goes back to this whole thing about past performance is no indicator of future value.
And I would imagine that this would be especially bad for someone, let's say, who's selling a property that is very unique. Let's say they've put a lot of money into it, and now it's a unique property. It's not similar. There aren't really any comps near it, comparable homes near it. Now it becomes really hard to value, and probably the person who's selling, I've had some experience with this where they're selling, it takes them years to sell the property because it's been overpriced. And
absolutely,
there's no real comp, so they can't say, someone can't come in, someone like you or their realtor can't come and say, well, look, this is what the house is worth because we have comps that are nearby, and then you convince the client, the seller, it's only worth X because this is such a unique home and it's different. You really don't know what it's worth until someone comes along and gives you an offer.
Right. And so at the end of the day, it's the market that makes the decision. And of course, you love things. We have this real weird...
especially with real estate for some reason, yeah.
I mean, humans do.
And with gold, for example. People love gold. It's a shiny metal. There's another thing where people think it's worth... I mean, that there you have an active market, so you know what it's worth, but people perceive it's going to be worth more in the future.
Yeah, I mean, so it goes back to endowment being the perception of value for something you own or that you perceive to own.
Or that you want to own.
Yeah, or that you perceive to own that is based on your own subjective valuation and not what the market's willing to give you. So there you go. And it really fits well with real estate because especially when it's your own home or it's a home that you've helped build, because there is a certain there is this sort of
an attachment.
Maybe, yeah. It's like it's like how you anthropomorphize animals. You kind of do the same thing with things that you like. Mm-hmm. You have this. You reflect your emotions off of
or a car that you loved,
or a car that you loved. Exactly. So nostalgia plays into it too. Yeah. Okay, so that's the endowment effect. I think everybody can relate to that one. It's relatively a simple one to work through. The title doesn't really give it justice. Now let's talk about present bias.
Yeah, this one actually plays in directly to retirement planning, I think. And we actually talked about this in a previous episode where, this is where, and a good example of this is just not saving enough for retirement. And there was a study that was done at Stanford some years ago where they looked at, these were college students who were trying to make decisions in this study about how much they should be saving for retirement. And what they found was that if there was a strong present bias going on, like where you're focused on what's happening now and you kind of ignore the future. If you gave these students an age enhanced or an older version of themselves in a photo, if you gave them a picture of themselves that was aged, they would save, I think, 40% more money in this example. It was a hypothetical where they were asked how much of your paycheck would you save for retirement versus spend on things. The students that had these age-enhanced older versions of themselves shown to them saved a lot more. So it's where they were trying to get around this present bias where we're just focused on the present time and ignoring the future. And again, this comes back, I think, to our evolutionary history, where you're focused on what's going on right immediately. Survival at the time is really the only important thing from our past. All this stuff about retiring, even retirement itself is new, very new. I think the initial time when people started thinking about retirement was after World War II. I mean, it's very recent.
So it's basically this idea of procrastination.
Yeah.
put it bluntly.
It's a procrastination
trap.
Yeah.
And that's the way I think about present bias. Is I just think of it as procrastination. It's you just don't realize that you're going to age. It's going to happen. And so you're going to have to do. Let me go back. That's too much. So simply put, present bias is procrastination. It's putting way too much weight on the here and now and not enough weight on what your future holds.
There's also an imperception or a misperception, I should say, of rates of return on investments. Like if people are given, and there was a study that was done where they gave people choices between different types of investment returns, and people routinely decided they'd rather have the money now than invest it. And the numbers they were using were pretty high return numbers, but they were somewhat hidden, and because they were doing it, I think, by a week. So they gave people, you can have this money now, or you can have a little bit more in a week. Which would you take? And the one that was a little bit more in a week, if you annualize that return, it was really high. But people still wanted the money now. They didn't want to wait.
Because they don't want to wait.
They didn't want to wait. And this was also done. There was another study at Stanford that was done. Again, we talked about this in another episode, where young children were given marshmallows, and those that were willing to wait and get additional marshmallows actually turned out to do better in life because they had this ability to...
They had the temperament.
Yeah.
They had the temperament. I have to say, we did an experiment similar to that. That reminds me of an experiment that we did in science camp many, many years ago. God, I'm dating myself
When
now.
you were a kid?
Yeah, this was probably in the mid to late 80s at some point. But I vividly remember almost exactly the same exact exercise that we did, but we did it with Starburst. And I love Starburst. So I went crazy on the Starburst. I just grabbed as many as I could. And unfortunately, that did not happen to be a good temperament to have in life for investing. So teach your kids about present bias. It's you want to
you might have to force them.
Yeah.
To save. Like, I can remember a lot of kids when I was growing up, if you got an allowance, first of all, you had to work for it. You didn't just get it because you existed. You had to do some work for it. And then when you got the money, you had to split it up. You were forced to only keep, I think it was a quarter of it. Most people, most kids at that time, you could spend a quarter of it on whatever you wanted. You got to donate a quarter of it to charity. You've got to give a quarter of it back in taxes. And I can't remember what the other one was, but that was how we set things up back in those days.
Right, and it's a good analogy for the future, actually, when you teach your kids that kind of thing, because you realize that a paycheck, your gross pay,
it's not going to be what you get.
It's not even close to what you get. I literally cry every 2 weeks when I look at my paycheck versus what the gross pay was.
Where did it all go?
Right. All right. So we've taken care of present bias. Now let's talk about mental accounting. That's number 7 on our list.
Mental accounting. So this is where you you do a mental budgeting, a mental bucketing type of approach where you look at money and you say, okay, this money is for this purpose. Maybe it's the conservative bucket, and then you've got the mid-range bucket and your long-range bucket. So the brain tends to think about money in separate pools, separate buckets, if you will. That's one example. There actually is a bucketing strategy. We talked about it in a previous episode where this is a valid distribution strategy that some people use, and it's based on this psychological effect. So it makes you feel good. I think that's what I said about the bucketing strategy is its main benefit is it makes you feel good.
Well, I mean, you were talking about a good example before on this one, which I think everyone can relate to, which is a tax refund, right?
Oh, yeah.
You tend to think about, and this is why, every year right around tax refunds, you get a whole lot of consumer spending. You get consumer spending go up because people don't think that tax refund that they're getting back is actually their own money that they overpaid
for
to the government and got no interest for, by the way. So it's actually of less value now than it was when they were overpaying. But they feel like, oh, well, this is free money that came into my pocket. It's not free, but that mental accounting, unfortunately, puts it into that free bucket. And then they end up splurging that money rather than treating it like it was any other source of capital or income that it would be coming in. So with the same discipline and rigor, they might be, treating their, say, standard paycheck.
And gambling is also related to this. If you're a gambler and you have a winning streak, that money that you've won, rarely does anyone, maybe professional gamblers handle this differently, but I'm thinking just everyday folks. I can remember just having fun going to Las Vegas or something to gamble and seeing all my friends. If they did well, they're not going to stop. They're going to invest that money actually more aggressively, the money that they've made, because it's again like free money, like you said.
Right.
So when any way that you get what your brain perceives to be money that you didn't earn or you didn't have to work for, this is one of the reasons why I really favor educating children on having to, have a strong work ethic, because you want to avoid this.
Well, and then there's another one we talked about, remember, which was the whole debt saving paradox, which was actually, I was like, wow, that's a good one, because I fall into that trap all the time, which is, look, let's say you carry $5,000 worth of credit card debt that you got to pay off, but then you've got that $5,000 in your savings account that's staring you in the face and makes you feel comfortable. But in the meantime, you're paying 22% or 20% on that $5,000 credit card debt as you're trying to pay it off month after month after month. And common sense tells you paying it off right away is a lot better than paying 22% per month on that debt. But that sense of comfort that you get in what's in your savings account, which is that bucket that you've earned money and you've put money into, outweighs that.
Well, one of the reasons that the bucketing strategy for withdrawals is so attractive is because you've got that very conservative cash bucket. And I think I mentioned in the podcast that one of the criticisms of that approach is you end up oftentimes with too much cash, because it's super comfortable. So it feels good to have it. And it relates to what you're saying is what if you had credit card debt, you should be paying it off with that money.
Right.
But it feels so good to have it. It's a safety sort of emotional thing. It's a challenge.
Yeah. So to put it simply, mental accounting is a tendency to treat money differently based on how you've bucketed it. And how you bucket it is based just on your own mental perception of where the money came from. So you have to so this is an open-ended one, and you have to be careful about it. I think the best way for me to treat this one is all the money should be equal, right? The way that you discipline yourself in terms of the investment framework you come up with and how you save, or how much money goes into your savings account, how much money goes into the pool where you can, just spend it freely, willy-nilly, how much goes into your retirement, should be consistent irrespective of where the money comes from. You win at gambling, you get a refund from the IRS, all the same. Treat it with the same rigor. That way you don't fall into this trap.
Well, this is a good way to avoid this is to use one of those 3 strategies we mentioned in the beginning. This one being like, just wait. If you have something that you want to do, let's say you get your tax refund, don't do anything. Force yourself not to do anything with that money for, let's say, 2 weeks, a month, just let it sit for a while and let it become normal money, not this free money that came in, through the taxes or what have you. That would help a lot. And that's, consistent across all of these biases, is having that waiting period, forcing yourself to have that waiting period.
Patience.
Okay, so we come to the last one.
Overconfidence.
This is where, well, you see this in all kinds of areas of life. All drivers think they're better than average.
Absolutely.
It's where you just think you're better than you actually are. I think students probably, if the average grade is whatever it is, most students think they can get better grades than that. That's overconfidence. This brings us to the last heuristic, overconfidence. This is where we all think we're better than average in some way. This has been studied. This is consistent with everyone, I think, where if you survey drivers, most of them would say they're better than average, which of course is statistically impossible. Investors think they're better than average, and so on. You see this, I've seen this myself with my clients, certain clients, where you have someone who's become your client. They've saved really well over the years. They're extremely successful at their profession. Let's say they're an incredibly successful physician, a surgeon, a lawyer. I get a lot of lawyers in the area here, or it could be a CEO of a company who's been very successful in their company. They tend to think, well, I was good at what I did. I'm smart because of that, and I'm gonna do really well with investing. I really, I don't need that much advice or what have you. So there's this kind of overconfident feeling that many people who were successful in a previous career have with regard to investments, and they don't realize that investments are, it's completely different than other things, and hard to do well.
Yeah, I think we've all been there for sure. I mean, you're on a winning streak. It's like when you're gambling. It's the same thing. You're on a winning streak. You think it's going to continue. You think it's somehow your skill is driving that winning streak.
That's a good point.
And you continue the process. I mean, I've been, and the thing about success in investing is you're really successful and you're really smart until you're not. And when you're not, it can hurt really, really bad. So I think what I got out of this one was be humble.
Yes.
Be very, very humble, because what is success today can be devastating failure tomorrow. So the same exact investment strategy you follow today can be horrible tomorrow. So it isn't, for the average investor that is not a professional and is not a financial expert, I would say just because you're doing really well this month doesn't mean you're going to be doing well next month. And I think you've said this like over and over again in different ways, but past performance is not indicative of future performance. And so don't give yourself a big pat on the back because you've been doing really good for the last 3 months. Be very humble about your investment approach and what you're doing, especially if you're not using a professional to help you.
Another example of this, I haven't had a lot of this with my client base because my client base tends to be they're really good listeners. You know, like they've listened to me long enough that they listen well. You know, they just acknowledge it. But on occasion, I've had some clients who were overconfident in their ability to make it through their savings. Like, it's been rare, but it can happen. I think probably more without an advisor there to guide. But sometimes, especially if you have a successful person, they just think, well, I don't need more money, or I don't need to handle this differently. I'll just, make what I have work. So there's that overconfidence, thinking that their retirement is going to be fine given their asset base. When if you did an objective analysis, you might say, well, look, you're a little short on this, or something's not quite as secure as you think it is. Let's make some adjustments to your spending and so forth. That's something that, I haven't seen much of this, but it is something to be thinking about. Most people tend to underspend than overspend, but every once in a while you come across a client who just wants to spend too much, and you have to kind of gently remind them or show them the facts.
Well, basically shake them out of their overconfidence.
Just got to, give them a little wake-up call.
So, when you look at a lot of these, you see the word bias at the end of them, right? Of these heuristics.
Those are the names, yeah.
Yeah, we see the name bias at the end of them. I think that sums up pretty much the crux of what we're talking about here, which, whether you remember the exact vocabulary or the terminology that we use to describe these behaviors, at the end of the day, what we're trying to say is that your brain isn't wired to be rational with respect to investments. And there are a multitude of ways in which you're not wired properly. These heuristics explain them in a kind of more methodical and scientific approach, even though some of them, if you read through all of these, kind of cross the boundaries of each other. There are some that really sound similar and where the effects are similar. Point being, you need to be humble about your investments. Past performance is not indicative of future performance. Seek professional guidance if you can. And if you can't, remember what Dan always says, which is you need to be disciplined. You need to have a framework that you need to reference. And you need to educate yourself as much as you can about these heuristics in order to be able to at least try and avoid them at a timely enough or in a timely enough way that you don't find out that you've fallen into one of these traps and it's caused you some kind of financial loss.
Very well said. I think that captures the whole episode.
Yeah, that's essentially what I got out of this. So if even if you don't remember the vocabulary, remember that.
Remember the concepts. Right?
Absolutely.
Well, that was great. Monie, enjoyed talking with you about all this.
Same here. This was interesting for me.
I hope the viewers also found it interesting, and I look forward to talking with you next week about the next subject.
Chapter 5.